Hello and welcome back to the channel, where we dive deep into the fascinating world of how to borrow stocks and potential short squeeze setups. Today, we're taking a unique and highly personalized look at a specific name that recently landed on our radar: Wearable Devices Limited, ticker symbol WLDS. We're going to break down exactly what makes WLDS stand out, why it's hard to borrow, and what that could mean for its future. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Your WLDS logo/chart Wearable Devices Limited, or WLDS, operates in the technology and consumer electronics sector. This company is pioneering a non-invasive neural input interface, essentially allowing users to control digital devices using subtle touchless finger movements. Their modular development kits are designed to empower users with new ways to interact with everything from smartwatches to other consumer electronics. WLDS is a microcap stock with a current market capitalization of just $5.06 million. Joe market cap on screen. Looking at recent price action, WLDS saw a significant drop today, down 18.99%. Over the last 5 days, it's down 19.50%. However, if we zoom out to the last 30 days, the stock is actually up a robust 26.98%. Volume today was 565,928 shares, which is relatively low compared to its 30-day average volume of 2,753,633 shares, giving it a relative volume of just 0.2x. This lower volume could be significant in a squeeze scenario, as we'll discuss. What is cost to borrow and why it matters. So, what exactly does hard to borrow mean, and why should you care? When a stock is hard to borrow, it means there's a scarcity of shares available for short sellers to lend. To borrow these scarce shares, short sellers have to pay a fee, known as the cost to borrow, or CTB. Think of it like renting a car: the higher the demand and lower the supply, the more expensive the rental fee. The cost to borrow is an annualized rate, which means these fees compound daily. When CTB fees climb into the hundreds or even thousands of %, it puts immense pressure on short sellers, making it very expensive for them to maintain their positions. This pressure is a key ingredient for potential short squeeze. Why this stock is hard to borrow right now. WLDS has caught our attention with an annualized cost to borrow fee of an astonishing 731.8%. Highlight CTB number: this is an extremely high fee, indicating a significant scarcity of shares for lending. The estimated float for WLDS is also quite small, at just 1.9 million shares. A small float means fewer shares are available for trading and borrowing, amplifying the impact of demand or supply changes. While the exact number of shares currently available to borrow is unknown at this moment, CTB this high strongly suggests supply is constrained. Our internal composite squeeze score for WLDS is 47.6 out of 100, which factors in CTB level, float size, and other metrics. Remember, a high cost to borrow does not guarantee a squeeze. It can also reflect strong conviction from short sellers who are willing to pay these high fees to bet against the company. Squeeze mechanics explained. So, what happens in a short squeeze? It starts when the price of a heavily shorted stock begins to rise. As the price goes up, short sellers who borrowed shares and sold them, hoping to buy them back cheaper, start losing money. If the losses become too significant, or if their brokers issue a margin call demanding more collateral, these short sellers are forced to buy back shares to close their positions. This forced buying creates a sudden surge in demand for the stock, driving the price even higher, which in turn triggers more short sellers to cover. This feedback loop can lead to a rapid and dramatic price increase. With WLDS's small float of 1.9 million shares and currently low relative volume, any significant buying pressure could have an outsized impact, creating a volatile environment. Dilution risk check. One crucial factor for any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can offset or even negate the upward price pressure of a squeeze, as the market is flooded with new supply. For WLDS, our check for recent dilutive SEC filings like SMINUS-1, SMINUS-3, or 424B in the last 90 days found no such filings. This is a positive sign for squeeze thesis, as there isn't recent immediate evidence of the company planning to issue new shares and dilute existing shareholders. Recent reverse, but watch. Another important piece of context for WLDS is its recent reverse stock split. The company executed a 1-for-3 reverse split on June 22, which was 39 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For example, if you own 3 shares at $1 each, after a 1-for-3 split, you'd own 1 share worth $3. One common effect of a reverse split is that it reduces the float, which, as we discussed, can amplify volatility. Historically, many micro-cap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market adjusts to the new share structure. While WLDS is just beyond that typical 1-month window, the effects and dynamics of that recent event are still highly relevant to its current share structure and potential for price movement. It's a pattern observed in some microcap names, not a guarantee for any specific stock. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with WLDS? First, watch for any significant increase in volume from its current low levels. Sustained buying pressure on increased volume would be a key indicator. Also, keep an eye on any further updates regarding the availability of shares to borrow. A shrinking supply can intensify the squeeze potential. Finally, while short interest data is often delayed, a significant reported increase in short interest would confirm the high demand to short that the CTB already indicates. WLDS presents an interesting case study with its extremely high 731.8% cost to borrow, tiny 1.9 million share float, and the absence of recent dilutive filings. Add in the recent reverse split and its historical tendencies, and you have a stock with several characteristics that can contribute to significant volatility. Whether this leads to a short squeeze or simply reflects strong short conviction remains to be seen. Always remember that these are high-risk, high-reward situations, and thorough due diligence is paramount. If you found this deep dive into WLDS insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments if you have any questions or other stocks you'd like us to cover. Thanks for watching, and we'll see you in the next one.